Welcome to the Deep Dive, the place where we take the fire hose of complex financial information and distill it down to the essential, surprising, and actionable insights you need.
Our focus today is, a really deep exploration of the Q3 2025 earnings landscape in the insurance market. We've synthesized the recent earnings calls from four major players, though they're quite different: WR Berkley Corporation, WRB, Chubb, Old Republic International, that's ORI, and RLI Corp.
Yeah, and we're not just looking at the spreadsheets. We're digging into what management actually said, their commentary, plus the detailed financial metrics. We want to compare how these giants are, navigating what they themselves are calling a highly transitional market.
And what Q3 2025 really shows us is an insurance market with some intense contradictions. Success seems really segmented right now. It's concentrated among firms that show real specialization and, crucially, capital discipline.
Right, but at the same time, these are the very firms generating record profits, maybe even historic levels of profit. And yet, you hear management warning about the industry's tendency to self-sabotage when there's too much capital floating around.
Exactly. That contradiction, these huge profits right alongside this deep market cynicism, that's kind of our lens for this deep dive.
So our mission today is to show you where the money's being made, which lines of business are still hard, which ones are softening up, maybe dramatically. Okay, let's unpack this, starting with the headline numbers: profitability, net income, operating income, and, the big one, the combined ratio.
Yeah, the measure of underwriting health. And WRB certainly set a high bar here. A classic example of specialized profitability, really. They reported pre-tax quarterly underwriting income that grew 8.2% to $287 million. Their net income, $511 million. That's 1.28 per share.
But the operational story, that tells you maybe more about the quality of that income, doesn't it? Their core operating income was $440 million, or $1.10 per share. That's a solid 12% increase year over year.
Right. And importantly, their calendar year combined ratio landed at 90.9%. Now, for a big diversified specialty carrier like WRB, keeping it under 91 for the calendar year, that suggests some serious underwriting discipline, especially when you factor in potential cat exposure.
And the capital returns metrics are just, extraordinary. They achieved a 24.3% return on beginning of year equity.
And get this. The operating return on beginning of year equity was 21%. I mean, those are numbers you might expect to see in high growth tech, maybe, not typically in cyclical insurance.
It really underscores the leverage they're getting, doesn't it? Both from that disciplined underwriting and, of course, rising investment income.
Absolutely. So if WRB is the highly specialized player hitting peak performance, how does a global giant like Chubb compare? They also called it a record earnings quarter.
They certainly did. Chubb's core operating income hit an impressive $3 billion. That's a massive 29% jump year over year,
leading to earnings per share of $7.49, up 31%. But maybe the most eye-catching figure, reflecting that pure underwriting quality, was their published combined ratio. It hit a record low of 81.8%.
81.8. That's 6 full percentage points better than the prior year. I mean, in this business, 1 or 2 points is significant. 6 points for a company Chubb's size, that's just staggering.
That's right.
Speaks volumes about their risk selection and, favorable loss experience this quarter.
And the returns reflect that. Chubb posted an annualized core operating return on tangible equity that figure strips out intangibles, gives you a truer picture of returns on shareholder capital of 24.5%.
Okay.
And their core operating ROE was 16.3%. So it's clear both WRB and Chubb are operating right at the peak of the sector's current profitability cycle.
Okay, next up, Old Republic International, ORI. They're a bit different, right?
Yeah.
Because they have that significant title insurance business alongside their specialty P&C. Their results showed, steady improvement, measurable.
Yeah, consolidated pre-tax operating income for ORI increased to $248.2 million. That's up from about $229 million a year ago. Net operating income per share up 10% to $0.78.
Interestingly, though, ORI's consolidated combined ratio actually nudged up slightly. It was 95.3% compared to 95% a year ago. So a little bit of a slip in that pure underwriting margin.
Right, but the overall financial health still improves significantly. The annualized operating return on beginning equity jumped to 14.4%. That's up quite a bit from 11.9% year over year.
So that increase, it points heavily towards those tailwinds from the investment portfolio, doesn't it? And probably strong performance from the non-P&C side, like title.
Exactly. And finally, RLI Corp, a premier specialty insurer known for focusing on niche markets, think excess liability surety. They reported operating earnings of $0.83 per share. Pretty robust, supported by a nice 12% increase in investment income alongside their solid underwriting.
RLI's GAAP net earnings were $1.35 per share. That's up substantially from over $1.03 in Q3 2024. And their combined ratio is very strong, 85.1%. That's almost a 5-point improvement from 89.6% year over year.
Yeah, big improvement. Management highlighted they're hitting a 20% plus return on equity, and their book value per share grew an impressive 26% year to date, and that includes dividends.
So when you synthesize this first theme, it's clear. All four are highly profitable, but the drivers are a bit different. Chubb's winning on sheer scale and efficiency. That 81.8 combined ratio tells the story.
Right. While WRB and RLI are winning through that deep specialization and really leveraging investment income, posting combined ratios, more in that 85% to 91% range, which is still excellent. ORI is benefiting from its unique mix, especially title.
Okay, so massive profitability confirmed. Let's pivot to growth. How are these companies actually capturing business? What's driving their net and gross written premiums? This is where that specialization idea really gets tested, I think.
Definitely. WRB, for instance, achieved a record net premiums earned of over $3.2 billion. Their total top line grew a respectable 5.5%. But when you look at the drivers, it really confirms that focused specialty approach.
What do they highlight?
Management pointed to their private client personal lines effort, Berkley One, and also their accident and health business. These seem to be key expansion areas for them, areas where they feel capital can be deployed profitably and rates are still holding up.
I found their commentary on reinsurance growth the most revealing, actually. It really shows their strategic thinking. They said reinsurance growth was driven by property exposure, but management was incredibly candid. They described this as getting their last bite at the apple before the apple starts to rot.
That quote is pretty critical, isn't it? It implies WRB sees margins eroding fast in property reinsurance. Capital's coming back, competitive pressures are building. So they decided to write the premium now, capture maybe one last cycle of adequate pricing, but they strongly signaled they'll pull back as pricing softens further.
Makes sense. What else drove their growth?
They also saw growth in excess workers' compensation. That's a line needing specific expertise, often resist those broad cyclical softening trends.
Okay, so contrast that kind of strategic withdrawal almost with Chubb's growth profile. Theirs was distinctly broad, showing the power of that global diversification. Total company premiums grew 7.5%.
And the consumer lines were the real standout there, up almost 16% globally. Shows really strong appetite from affluent customers for their products. Commercial lines growth was a bit slower, 3.3%, although their underlying renewable P&C business grew about 5.5%.
Their international footprint seems key to the strategy, too.
Absolutely essential. Overseas General, their international arm, grew robustly at 9.7% or 7.5% in constant dollars. This was fueled almost equally by consumer lines, up 15.5%, and commercial lines up nearly 6%. Asia, specifically, grew over 14%. That's clearly a key geographic engine for them.
And what's strategically fascinating to me is just the scale of their North America high net worth personal lines business. That segment generated over $1.8 billion in net written premium, growing 11.5%, and it's now rapidly approaching the size of their entire North America middle market commercial business, which was $2.1 billion.
Yep. Think about that. A high net worth consumer segment rivaling a core middle market commercial segment. That demonstrates a really powerful and, frankly, successful strategic shift towards that affluent customer base.
And they're bringing in new business fast, too, right?
Yeah, the sheer velocity of their new business writings, up 24% versus the prior year. That signals not just good retention and renewals, but really aggressive, effective prospecting. They're leveraging their brand and that global distribution network effectively.
Okay, moving to ORI. Their growth story is kind of split, isn't it, between specialty P&C and their powerful title segment.
Exactly. Specialty insurance net written premiums grew 6.9%. Pretty stable growth in commercial auto at 7% and workers' compensation at 6.7%.
But the title insurance side was the volume driver.
Oh, definitely. Premium and fee revenue there grew 8.3% to $767 million. And it was driven overwhelmingly by strong commercial sector activity. That's significant because, the residential housing market has been soft with high interest rates, or are really capitalized on large commercial real estate deals, refinancing, development transactions.
And that commercial title activity is becoming structurally more important for them, it seems. Commercial premiums now make up 26% of title earned premiums. That's up substantially from 20% just a year ago.
And another key point Agency-produced title premiums, which tend to be pretty sticky, were up 11%. They make up nearly 80% of revenue now. So it really highlights how successful their specialized focus has been, shifting away from that volatile residential mortgage market.
Right. Then there's RLI. Their top line gives maybe the clearest picture of this specialized market, contracting and expanding at the same time. Overall top-line growth was pretty flat for the quarter, though premiums were up about 2% year-to-date.
But that flatness, it masks some massive strategic movements underneath.
Like what?
They focused heavily on casualty. Their casualty segment of gross premiums advanced 8%. That was led by personal umbrella, up a staggering 24%, and E&S casualty brokerage up 12%.
So that aggressive casualty growth was basically compensating for a sharp drop in property.
Exactly. The property segment saw gross premiums fall 11%. Management pointed straight at the softening E&S property conditions, especially in that large risk-shared and layered market, the same area WRB noted intense competition.
So, like WRB, RLI showed they're willing to let the top line shrink if the margins aren't there.
Precisely. Profit over volume. They did note one very strong, highly specialized growth pocket, though, Hawaii homeowners. That was up 33%. Surety gross premium was down modestly, reflecting about a 5% drop in contract surety, which can sometimes be a bellwether for construction activity.
Okay, so theme 2 really shows this critical divergence. You've got Chubb, driven by global scale and those high-net-worth customers, achieving broad growth.
While WRB and RLI are getting selective, profitable growth by rapidly scaling up casualty and personal umbrella, while simultaneously and strategically pulling back from those large-scale volatile property markets where capital is just flooding back in.
That segmentation makes underwriting quality, the engine that generated these record profits, even more critical. Let's look closely now at how they managed loss and expense ratios, cat exposure, and that crucial metric for long-term health. Prior year reserve development, or PYD.
Right, let's start with WRB again. Their current accident year combined ratio, excluding cat losses, was 88.4%. That's the pure performance of their current book.
And the cat losses.
They totaled 2.5 loss ratio points, or $79 million. That was actually down from 3.3 points, or $98 million the year before, primarily attributed to specific southern catastrophe events, SCS they called it.
What about expenses?
A key factor in their operational efficiency was the expense ratio, managed well at 28.5%. Management specifically said this benefited from recent startup units, sort of gaining scale, and also efficiency from ongoing tech enhancements. That's the payoff from prior investment kicking in.
And reserves. Any big surprises in PYD?
Management noted that overall PYD was incremental. Almost a wash, really, balancing out between the insurance and reinsurance segments. So no major reserve surprises, good or bad. Pretty stable.
Okay. Chubb's underlying performance also looked robust, driven by exceptional risk selection. Their current accident year underwriting income, excluding CTs, was a record $2.2 billion.
Yeah.
Supported by an 82.5% combined ratio ex-TD.
Yep. Pre-tax cat losses were $285 million, with 86% of that coming from the U.S.
The reserve story seemed a bit more complex, though. It tells us something about the quality of your past underwriting, right?
It does. They reported very strong pre-tax favorable PYD of $422 million from their active companies. But what's fascinating is the composition. $460 million of this was favorable development in short-tail lines, things like property, marine, aviation. That suggests they had significantly over-reserved for these risks in prior periods.
But that was partially offset.
Partially offset by $38 million of unfavorable development in long-tail lines. That typically includes complex liabilities like professional indemnity. It suggests, the effects of social inflation are still causing some creak in those long-duration reserves, even for a company as disciplined as Chubb.
Any other reserve notes?
They also noted adverse development of $61 million in their corporate runoff portfolio, mostly linked to very old environmental claims. Kind of legacy stuff.
And we should talk about their expense ratio composition. The P&C acquisition ratio went up.
It did, but management explained this was due to a mix shift. They're writing more middle market, small commercial, and consumer lines. Now, these lines carry higher commission rates, hence the higher acquisition expense. But crucially, they also tend to boast more favorable underlying loss ratios.
So it's a deliberate strategic trade-off. Pay more to agents to acquire better, less volatile risks.
Exactly. Pay for quality.
Okay, on to ORI. They seem to benefit quite a bit from reserve releases. They reported favorable PYD resulting in a 2.5 percentage point benefit to the consolidated loss ratio. That's nearly double the 1.3 points from a year ago.
Yeah, and this development came predominantly from long-tail lines. Workers' comp accounted for most of it, but commercial auto, general liability, and property all contributed positively as well. It really indicates that their historically conservative reserving practice in these long-tail lines is now paying off. It's kind of a hallmark of good specialty carriers.
But their expenses went up. The specialty insurance expense ratio increased to 31.3%, up from 28.8%.
Right. Management attributed that jump primarily to investments in technology and higher personnel expenses. That includes costs tied to new specialty operating companies that aren't even generating premiums yet.
So that's deployed capital, paying today for the scale and efficiency they hope to get tomorrow.
Precisely. Investment spending.
And RLI. Their strong underwriting and that lower 85.1% combined ratio seemed heavily helped by a quiet hurricane season.
Management basically said so, calling it a benign hurricane season in 2025. They also saw strong underwriting income benefits from positive PYD across all three segments. $8 million favorable in casualty, notably general liability and excess liability, $5 million in property, and $2.7 million in surety.
Universal reserve releases across multiple specialty lines. That's a positive signal about their reserving strength.
Absolutely. But like RRI, RLI's surety expense ratio rose. And again, management pointed to investments technology, people alongside higher acquisition costs.
So the recurring theme here is disciplined carriers actively increasing expense ratios, not because costs are out of control, but as a calculated investment in tech automation, AI, and the specialized talent needed to sustain future growth and pricing integrity.
Yeah, the underwriting results really confirm that dual strategy. You've got extraordinary profit generation supported by either favorable short-tail reserve releases like Chubb or conservative long-tail releases like RRI, coupled with that strategic investment in future operational efficiency, which we saw at RRI and RLI.
Okay, we've established the industry is highly profitable, highly specialized, but the market's clearly fracturing, especially in property. This brings us straight to reinsurance. That's where carriers manage their biggest risks and where cyclical pressure often hits first.
And WRB was definitely the most vocal on the market shifts here. Management observed that the bloom is off the rose in the property cat reinsurance market. They said margin is clearly eroding and eroding quickly.
They expect reinsurers to be hungry for business at 11 renewals.
They stated they anticipate a palpable appetite for lower rates coming from the reinsurance market at those crucial January 1st renewals. It signals that reinsurance capital is back and aggressively seeking deployment.
And they sounded frustrated about liability reinsurance.
Pointedly frustrated. They stated that liability reinsurers are not demonstrating enough discipline in pushing for harder rates, which, quote, endures to our benefit as a buyer of reinsurance.
That's remarkably cynical, isn't it, coming from a top management team?
It implies they see their risk transfer partners not pricing adequately for the liability risk they're taking on. Which, yeah, benefits WRB's expense structure today, but potentially exposes the wider market to future loss volatility if that risk isn't properly priced.
What about Chubb's view on reinsurance?
Chubb runs its reinsurance business, as they put it, a bit as a trade. They noted the recent decline in their reinsurance premium is a direct result of property softening.
So they're pulling back.
Chubb remains ruthlessly disciplined about price to model. They will simply shrink when prices are inadequate. Management said the premium decline is just the other side of that same coin of property softening. Confirms their commitment to profit over volume, always.
And Old Republic.
RRI didn't disclose specific ceded premium, retention activity, or really any detailed reinsurance commentary this quarter. That suggests either their activity is pretty stable or it's just less material to their overall P&C strategy compared to the big specialty players.
Okay, and RLI?
RLI anticipates that the outcome of the 11 reinsurance renewals will significantly influence overall market competition going forward. They also provided some specific, really valuable color on their Hawaii exposure. They noted Hawaii hurricane risk isn't really an emphasized risk by reinsurers.
Interesting.
And furthermore, they pointed out that only about 20% of their Hawaii book actually buys wind coverage from them. That effectively limits their net cat accumulation there and reduces their reliance on a highly volatile reinsurance cover in that specific geographic pocket. Smart risk management.
This reinsurance commentary feels crucial. The property cat cycle, which gave huge tailwinds in 2023 and early 2024, is clearly ending. Benign loss experience, massive capital injections are doing their work.
Meanwhile, the liability side seems kind of dysfunctional, driven by a lack of disciplined pricing among reinsurers, even with the clear threat of social inflation hanging over everything.
Which sets the stage perfectly for the core competition discussion. What carriers actually doing with pricing? How does rate movement compare to loss trends, especially as social inflation keeps eroding those casualty margins?
Right, and WRB management delivered probably the most sweeping and maybe pessimistic industry observation here. They believe the insurance industry continues to make an art out of self-sabotage because of its inherent cyclical behavior.
That cynicism comes from believing excess capital inevitably leads to dumb pricing, right?
Pretty much. Yet, despite that internal warning, their overall rate increase, excluding workers' comp, was still a solid 7.6%.
Where do they see the most competition?
They confirm the hotspots, intense competition in that shared and layered property market and E&S generally. Professional liability, they said, is a mixed bag. D&O pricing eroding slower than other professional lines. Commercial auto remains pretty choppy, highly exposed to social inflation, though they did note necessary rate action happening in California specifically because of the rise in cumulative trauma litigation claims.
Chubb offered that sharp contrast in pricing depending on account size. That really illustrates the segmentation we've been talking about. They characterized the global commercial P&C market as in transition, competition increasing, especially in large account short-tail business.
And their data showed large account property pricing was down a dramatic 13.5%.
Wow. But meanwhile,
Middle market and small commercial property pricing for Chubb was actually up 6.2%. This divergence is critical. Large accounts, they're highly sensitive to global reinsurance capacity, direct capital deployment that drives prices down fast. Middle market and small commercial is stickier, less sensitive to reinsurance, more driven by local loss trends. That allows for continued rate increases.
what was their overall North America P&C pricing?
Excluding financial lines and comp, it was up 4.3%. That was split between pure rate up 2.4% and exposure growth up 1.9%. Critically, casualty pricing was strong, up 8%, with the rate component up 7.5%. That reflects the continued necessary fight against loss trends driven by social inflation.
Financial lines still the outlier, though.
Still soft, down almost 2%.
Okay, ORI provides a focused counterpoint, especially in commercial auto, a line really exposed to these casualty trends. Management confirmed commercial auto rate increases stayed steady at a very high 14% level.
And they explicitly said that rate is commensurate with the observed loss severity trend, which they estimate is running in the low teens.
Okay, maybe we should define social inflation quickly for the listener here. When ORI says a 14% rate increase is just keeping pace, what they're acknowledging is that the cost of claims, not just repair costs, but legal costs, jury awards, litigation funding is escalating at like 10 to 15% a year.
Exactly. If their rates fell below that 14%, they'd immediately be running an unprofitable book of business. It's just keeping up with trend.
What about their workers' comp rates?
ORI rates there remained relatively flat. Management deemed that adequate because declining loss frequency, fewer accidents happening is more than offsetting the increase in loss severity trend. In title, they noted the soft residential purchase market, but, again, emphasized the strength in commercial sector activity driving their growth.
And RLI, another major casualty specialist. They emphasize persistent legal system abuse, complexity driving the need for price hikes.
Yeah, and their casualty rates are accelerating even further. Auto liability rate increases across their portfolio were 16%. That's up from 14% last quarter. Personal umbrella rates increased a steep 17%, driven by substantial rate filings, particularly in Florida, which seems to be a real hotspot for severity trends and legal system issues.
But in property, RLI felt the softening acutely. Property E&S rates on renewals were down 11%.
Right. But management took pains to contextualize this. They noted these rates are still 2.5 times higher than they were back in 2019, before the hard market really took off. It shows just how massive that preceding hard market was.
So even down 11%, it's still historically high.
Exactly. And their Hawaii homeowner saw a 16% rate increase, with another approved filing for an additional 12% to be added over the next year. So localized hard markets definitely still exist where accumulation risk is perceived as high.
The major strategic takeaway from pricing seems undeniable then. Property is softening dramatically at the large account level and in reinsurance. But specialization in casualty, personal umbrella, and disciplined middle market commercial lines. Still a hard market, characterized by necessary double-digit rate increases driven by that persistent social inflation.
And this high level of profitability, this pricing discipline, especially in casualty, has led directly to the central theme of this quarter. Just immense capital strength. So how are these management teams looking at their capital position and what's their strategy moving forward?
WRB management was maybe the most direct and possibly provocative on this. They reported having significant headroom in excess capital, potentially, get this, to the tune of 10 digits, according to rating agency models.
10 digits. We're talking billions of dollars of capital that they're generating faster than they can find places to profitably deploy it in their existing markets. Just piling up.
So what are they doing with it?
Well, they're focusing on returning this excess capital. Dividends, repurchases, when the opportunities look right. But crucially, their strategy remains deeply committed to underwriting discipline first. They explicitly stated they are willing to let the business shrink, if necessary, to maintain risk-adjusted returns.
Reinforcing that reputation as a disciplined, long-cycle player.
Absolutely. They're also optimizing their investment portfolio, noting a new money rate around 5% compared to their domestic book yield of 4.6%, just capturing higher returns there without taking on excessive credit risk. Smart financial management.
Chubb also demonstrated massive capital strength. They increased share repurchases to $1.2 billion in the quarter. How do they view their excess capital?
It's interesting. They don't see it as just a drag on ROE in the traditional sense. They prefer to view it as capital strategically deployed into alternatives which yield a higher return, though they still acknowledge the traditional drag on headline ROE is probably 2 points or more.
And they issue debt, too.
Yeah, $2.2 billion of debt at a really low 4% weighted average cost. That looks like a strategic move to manage the balance sheet optimally. Suggests a highly sophisticated strategy. Use cheap debt to return capital to shareholders while maintaining high levels of regulatory capital.
Strategically, Chubb actually increased its core operating ROE target to 14% plus over the medium term. They're citing strong and enduring earning power.
Yeah, their philosophy seems driven by this culture of discipline and continuous rebuilding, acting like they're chased every day, as they put it. And they estimate that 70% to 80% of their businesses still present attractive growth opportunities. That contrasts pretty sharply with WRB's willingness to shrink. Chubb is definitely the disciplined growth engine.
Okay, ORI continues its strategy of being inch wide, mile deep, right? Focusing on those highly specialized markets. They confirmed the pending acquisition of Everett Cash Mutual, ECM, a farm and ag specialty insurer.
Right, that'll become their 18th specialty operating company. Management confirmed the deal structure, a sponsored demutualization, means it won't materially hinder their ability to return capital, and they expect it to be immediately accretive to book value per share.
So the deal fits perfectly with their focus on acquiring hyper-specialized, maybe non-cyclical niche expertise.
Entirely consistent. And meanwhile, ORI paid $71 million in regular dividends, repurchased $44 million in shares. They still have $910 million authorized for repurchase. They also highlighted their competitive advantage in commercial auto, not just through rate adjustments, but also through extremely conservative reserving holding loss picks for 3 to 4 years before even considering a reduction.
That conservative approach is funded by the same excess capital driving the repurchases.
Exactly. And finally, RLI. Their capital position also looks extremely strong. Operating cash flow hit $179 million. That allowed them to purchase fixed income assets at an average yield of 4.8%. That's a 70 basis point advantage over their portfolio's current book yield.
So like WRB, they're getting immediate profit leverage from the rising interest rate environment.
Yeah. Their strategic focus is explicitly on consistency. Being a stable market, resisting those cyclical pressures that teams like WRB warn about. They're deploying capital internally, investing heavily in systematic improvements, automation, generative AI to support their underwriters and claims staff.
So the long-term goal is leveraging those internal efficiencies to drive profitable premium growth while absolutely maintaining underwriting integrity.
That's the plan.
Okay, so synthesizing all of this, Q3 2025 really demonstrates an insurance market in sharp transition. It's rewarding specialization in casualty, personal lines, small commercial, while large property risks face dramatic softening and increased capital appetite. The divergence is just stark. It proves a single view of the insurance cycle isn't really sufficient today.
Yeah, these carriers are all posting exceptional results. It's based on strong underwriting coupled with those potent tailwinds in the investment portfolio. But the abundance of capital is what really stands out, isn't it? That 10-digit headroom you mentioned, especially when you pair it with WRB's warning about the industry's innate tendency toward self-sabotage.
Exactly. You've got major carriers generating capital faster than they can deploy it profitably. They're sitting on billions in excess funds, committing to major share repurchases. And yet, A leader like WRB is publicly warning that this very excess capital is the fuel for the next destructive pricing war.
It's the capital paradox of the current cycle. Given that these leading carriers are showing unprecedented capital strength, is this vast surplus a sign of structural resilience? Does it protect them from external shocks? Or is it simply the unavoidable fuel for the next destructive pricing war, maybe coming in 2026?
It's a critical question. You, the listener, should really consider the long-term implications of managing such vast excess capital in a highly cyclical business like insurance. If even the disciplined players are generating capital faster than they can deploy it, and the soft market is beckoning in property and reinsurance, how long until that internal capital pressure forces them, or maybe their less disciplined competitors, to start compromising underwriting standards in 2026 just to keep the money working?
That is the crucial question for the future, isn't it? Will the commitment to capital discipline endure this enormous pressure of excess capacity? Or is the inherent cyclicality of the insurance market, driven by capital availability, simply an unavoidable force?
That's a powerful thought to leave you with. Thank you for joining us for this deep dive into the Q3 2025 insurance market earnings.
Until next time.